Welcome to the Weekly Spark, your fast 5-minute flash of insight into the world of mortgage and real estate. Every week, we're here to ignite your understanding of the market, from mortgage rates and housing trends to legislative updates and insider strategies. So let's strike the match and spark your week. This is the Weekly Spark.
Welcome back to the Weekly Spark in the mid-November. Big week in mortgage news. Jason, are you ready to roll?
I'm ready.
All right. Let me get these slides up here. So the first one, take a breath. Is the government shutdown finally over?
Yeah, so listen, this past Tuesday, the Senate voted to end this historic shutdown. And as of today, and we are recording, by the way, Wednesday, November 12th, it's been 43 days. And the House will now be voting to end the shutdown tonight. So we are hopeful it'll happen, Ryan. You know, we can get back to business finally. We can pay our fine pilots, our air traffic controllers, and our other essential government workers.
And you were only going to pay me 30? You're getting 30 grand? I'm getting 1,000.
You guys are getting paid?
Gets me every time. I feel like there's so much application for that little clip, but glad to see it finally ending. And we'll kind of talk about next week, most likely the impact of what's coming out of that after we kind of digest what's going on. So this week, Fannie Mae dropped their credit score minimum from 620 completely off. Tell us what you got about that and what kind of impact you think it's going to make.
Yeah, so listen, this could open up a lot of new doors because Fannie Mae, we couldn't even attempt to get an automated approval if you had less than a 620 score. So that hard cutoff is going away on November 16th. So Fannie Mae's approval system now is going to look at your whole profile, right? So, you know, it's going to look at payment history, income, debts, your assets. So it's going to be more similar to a VA or FHA loan. But at the moment, we don't know what rates are going to look like. We don't know what type of compensating factors these loans will require, and how quickly our investors will actually begin to allow these new guidelines. Because Ryan, as you know, even though Fannie Mae gives us the green light, our banks and our lenders may have their own overlays. So we'll be updating this as we get more data into next week. And realtors, if you're watching and would like to learn how to team up on marketing this product, just respond to this email or get with us and we can create some flyers for you to get you ahead of the game.
Yeah, I definitely want to get more information about this because there's a ton of misinformation flying around and everybody's, first response is always, oh, here we go again. And in reality, there's, in my thoughts, there's not a huge impact at this point because, as you mentioned, an FHA loan may be the better option still in those ranges because of the rates and the impact on everything else. So the big one this week is the 50-year loan that rolled out. What do we got?
Yeah, look, so there's a big debate across social media platforms between realtors and mortgage brokers and just everyone, right? So look, I'm a big fan of creating affordability, and the 50-year mortgage, it's not a magic fix, and it's certainly not for everyone. And listen, we also don't know as well what type of rates and fees will be associated with this loan yet. But, with prices and rates the way they are, Ryan, some families, they just can't get approved with a 30-year payment. So stretching the term can bring the payment down enough, and we can help renters who otherwise would never be able to buy a home. But here's the thing. We need to be really clear on the differences. You're going to pay more interest, and you're going to build equity slower, but you're going to build equity. So that's why I think it could be good, but only for borrowers who truly need it. And we need to show a side-by-side 30 versus 50-year comparison. And Ryan, I think you've got something that we can look at to go over the benefits.
Yeah, I've got some numbers here, and I like how you mentioned that only for the borrowers that truly need it. I'm truly hoping that in this scenario, when they roll this out, it's only for primary residence borrowers, because if it becomes available for investors are 100% about cash flow, and they're taking this deal every single time, which doesn't help affordability, and arguably it might make it worse. So with the numbers comparison here, we'll make that a little bigger. So this is on a 6% rate example, purely for rate example purposes, not anything that I'm quoting here. I got to throw my little disclaimer for the Fed there. So basically we're looking at about a 6% or at a 6% rate. Monthly payment wise, the 50-year be about $151 cheaper. So not a huge impact on the monthly payment. However, that's electric, that's water, that's, you're able to kind of quote unquote roll that into your main payment there by taking the 50-year option. Now, these are where the numbers that everybody's throwing around and saying how much worse it actually is over the life of the loan. And as loan officers, we've recognized that selling the life of the loan is a futile exercise. Like 5% of the people that start with a 30-year loan end with that same loan, right? We're seeing between 7 and 11 years, 95% of the people are refinancing, selling the house, moving to a bigger place. It just doesn't happen all that often anymore. And when it does happen, if those people are staying in that house, they've become financially stable enough to accelerate the payoff anyway. So these numbers change entirely. And, you know, they're getting into mainly their house is their only debt at that point for the most part. So we're looking at it's like $340,000 extra in interest if you would pay for the full 50 years. Obviously, 20 more years of amortization is going to hurt. So I did a little equity earned by year 7, and this does not take into account, you know, the average of 3 to 5% that we're gaining with amortization. This is just about the loan. And this brings in roughly about 15.5 less in equity earned on the loan by year 7. So it's, you know, while we see this big $340,000 difference at 6%, it's only $15,000 worse over the first 7 years. So, you know, and your payment's $151, and you could probably offset that with investing that somewhere else if you had that ability. So I also threw up a 5% option here or example here. And I did this because we're kind of hoping rates are going to come down, right? We know, ultimately we may know that they're going to come down at some point. The 50-year gets more and more attractive monthly as we get down in rates. And so just a 1% difference in rate, you know, adds 60% in savings on the monthly payments. We go up to 246 instead of 151. And look at the difference here. So we've saved another 90,000 in interest. That's it. The difference is 238,000 instead of 341,000. So as we get lower in rates, which is ultimately the only way that affordability comes back, it's the only way, is if rates can come back down where people can afford it. This gives a helper for that. And then if it's in tandem with the rates coming down, I think it can end up being a really great product for the people that truly need it. So that's what we got this week. If you got any questions on, you know, like Jason said, advertising any of this stuff or marketing it so that you can get clear, actual information out to your clients and friends and other agents, we want to promote correct information, true information, not a lot of the stuff that's flying around. Get with us, or help you organize it and get a little plan in place. So thanks for watching the Weekly Spark, and we'll see you next week.
That's a wrap for this week's edition of the Weekly Spark, brought to you by Creative First Mortgage. If you've got questions or want us to cover something next week, please let us know, shoot us a message, and until then, keep your deals moving and keep your week lit. See you next time.